Markets down a little bit. It's Tuesday, August 5th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan.
That's
Here
right.
to take you through the rest of that is where you are. Here to take you through the rest of this hour as we wrap up the trading day. Futures market closes at 5 Eastern, 4 Central. If you're watching on the platform, tastylive. If you're on the platform, Tasty Trade. If you're on the website, tastylive.com, welcome. Come over to YouTube. Tell us what you think of this action, what you think of this market that declined after this morning's PMI services report. U.S. economy stagnating a bit, growth coming in, employment falling off, prices paid, highest level since October 22. Not a great sign for the largest part of the economy. Bond yields up and down across the curve, a little bit of a twist with lower yields at the longer end. Gold and silver are able to take advantage of that and climb back from some recent losses. The dollar holding ground, not great, but oil prices drop. And so I suppose that's good news for the Russell, which is the only index that's able to eke out a gain today, up by 0.65%. Otherwise, the NASDAQ is off by 0.65%, the S&P down by 0.45%, and the Dow Jones with a more modest 0.13% loss. Dylan, you the ever optimist here, give us the lay of the land. We were just critiquing the Godfather himself, Mr. Sosnoff, for being a little bit too public in his opinion. But you seem to think that it's okay to be public these days.
So how do I contextualize this? I would describe today's sell-off at a high level as bullshit.
Okay. Well played.
I like it. I like it.
When I say that is that the underlying thesis that I assert is that the overwhelming force that is artificial intelligence, and please forgive me my colorful language, I shan't make it a habit, but I felt it was appropriate at this juncture. I believe that artificial intelligence is an overwhelming force. And I believe that any pullbacks on sort of pedestrian economic concerns of the likes of those who may have left Russia in their youth for the glorious life of the music festivals of Portola.
Happily, so happy.
With great joy and effervescence, I have no doubt.
Oh,
for the sweet smell of eucalyptus and sourdough bread.
Boundless love for all these things.
But regardless of the glory that they may enjoy on the hills of Portola as they partake of the sourdough and eucalyptus, they still hold an inappropriately pessimistic view of the world as it is portrayed in financial indices. And the reason that they do that is because they look at the world through some basic, practical, pragmatic, analytical framework, which is a source of comfort for them intellectually because they're very intelligent. But their intelligence in this particular instance is a massive liability because of the overwhelming, excuse me.
I love this.
I'm speaking, if you don't mind. Because of the overwhelming enthusiasm and abundance of glory that awaits those who choose to think less and rather enjoy the optimism of the unlimited potential that is a technological revolution that makes the emergence of the internet in 1995 or 94 or 96 or 97 or pick your year in the 90s look like that of a flea upon a horse's ass. Because the transition to artificial intelligence is a moment of historical revolution, the likes of which we have never seen before. And valuation is irrelevant. Basically, a blind monkey could select any of the AI adjacent or directly related names at any price point, and a year from now will make much more money than any fool who attempts to use their intellect, let alone their analysis, to try to trade this market. And that, dear Mr. Vecchio, is what I think on this particular day.
If ever there was the signpost of a market top, by the definition of what a bubble surely is, which is the disconnect of reason and valuation. That was as as eloquent a statement of a sentiment peak as certainly I've ever heard.
Well, thank you for your complimentary commentary, which I shan't take with any subtext of side insult that I think was there.
Well, you've been right.
I shall ignore.
There cannot be subtext because until this thing pops, you're right.
If I might refer to my dear friend and perhaps your neighbor, former Fed Chairman Alan Greenspan, the markets, good sir, can remain irrational far longer than you can remain liquid. I'm not sure that might be that's
a Keynesianism and
it's not really a Keynesianism.
And it's solvent, and it's not even. It's debated as to whether it's
anyway. Listen, whatever.
Anyway.
Okay, listen. You get my point.
Yes. Well, and
Vecchio's the citation.
And we've
I'm not
seen
here
that.
for quotations and citations. That's Vecchio's job. I'm here for a point of view.
And
listen, he's not the nerd.
To your point, that's exactly what we've seen. We have shown the markets
that is where we are, sir.
Rational longer
I would tell you this:
solvent.
you can either be long the AI, you can either take advantage of these idiotic sell-offs. So like, oh my goodness, look at this economic data. What about the PMI? What about the CPI? What about the jobs report? Oh, what about the overwhelming global technological revolution that renders your stupid economic data irrelevant? Good sir.
It doesn't make it irrelevant if you just look at the collective wisdom of the world's largest and most liquid stock market today. It's not me saying it, it's them.
0.4% between friends. It's basically a tip at dinner. Okay, come on. This is not a sell-off.
I mean, in the context of what happened last week, it's a beautiful rejection of yesterday's attempted rebound in exactly the place you'd want it.
Your adjectives are unwelcome. There's no reason to characterize its beauty and or lack thereof.
Dylan, I'm going to go get the doll and you're going to let me know where Ilya hurt you today. Okay.
Show me that dollar. What happened with that stupid dollar? Trump.
23,132 on the NASDAQ close. We're up a little bit after hours, back to 145. It's a 0.65% loss. We turned lower from where we more or less bottom out on July 30th, Ilya. Slight overshoot from some of the levels that we were looking at yesterday on Futures Power Hour and overtime, roughly 23,000.
Basically the bottom of that range.
Yeah, 350. S&P was 63, 65 or so.
Mm-hmm.
And we failed there. I think the reason and rationale for why we actually did pull back and fail away from these levels when we did this morning is worth looking into. You were mentioning the ISM PMI report, which I think is worth bringing up here on the screen for a quick second. The PMIs, as we often do when we discuss these, diffusion indexes based around 0. If you're above 50, you're growing. Higher above 50, growing faster. Below 50, contraction faster the more you are below 50. So the ISM comes in at 50.1, which is barely in growth territory, if at all. But it's the internals that bother everyone because the internals, as we look across the board, not only are they mentioning tariff. In fact, let me just search for the word tariff here on the screen. 1, 2, 3, 4, 5, 6, 7 mentions in there. What respondents are saying section. Basically, every response has a tariff notation. It's the fact that the employment gauge is falling deeper into contraction territory, and our prices paid index is now at the highest level that we've seen since October 22, which again, respondents are pointing to as the tariffs being responsible. So what does this tell us about the state of the economy now that we can no longer trust BLS data, as Dylan mentioned in his walk and talk rant this morning on Twitter? And are we now looking to the PMIs as our North Star?
All the data is bad. Anyway, sorry, go ahead, Ilya. Sorry.
All the data is bad.
All the data is bad.
We already said this yesterday. We already collectively agreed we're using bad data, but we're agreeing to use bad data because it's mutual agreement.
Yes. I think there's an interesting dichotomy here, and you have to give the devil his due.
Thank you.
There were two things that happened.
Assuming that was directed at me.
There was two things that happened today. And you can pick and choose your data. There was the PMI numbers from ISM, which we're looking at here, which were god awful and disappointing across the board. And indeed, the manufacturing component of this same survey that came out last week, that also disappointing. And you can look at that, and those of us of the bearish mindset can go, see, told you, ha, ha, ha. And then you can look at the S&P version of this same data, S&P Global. They came out with their version of PMI data. And on that score, the U.S. economy is near the peak of last year's explosive growth. Now, that survey was conducted much earlier. It's a different sample space. It's a different time that most of that data was collected. It was much earlier in the month of July. So you could say, okay, the ISM is more current, it's more recent, or you could say that the S&P Global is a better data set, and most PMIs around the world do indeed come from S&P Global. So you could look at that and say, well, that's wonderful for the bullish view. Forget this ISM, whatever. You might also say, well, what does it all mean and what does it matter? One thing is showing you this, the other thing is showing you that. Who cares? It's all bad data. It's all survey data. It was all screaming recession in February and March. Obviously, that didn't happen. It was more about the way that businesses felt, not what businesses did. Maybe this is something we can just write off altogether. And in my mind, there is a very simple way to kind of cut through the noise here and see which thing did the markets actually trade on today and what thing they actually paid attention to. And it's the ISM data, full stop. When that data came out, the stock market fell. That's it. And if you look at what happened with Fed rate cut odds in Fed funds futures, they've moved more dovish. And they've moved more dovish for next year again, not this year. This year, they're basically stuck at where the Fed thinks they're going to be. So very clearly, the markets looked at this ISM data. This is not anybody's opinion. This is the price action itself. And they said, uh-oh, higher prices, weaker employment. The economy needs rate cuts, and the Fed won't do them. Bad. Now, does that necessarily give you a narrative to extrapolate into collapse? Of course not. Does the economy stop mattering because we have a hype cycle in AI? No, obviously not. That has never happened in history ever. And we have had more transformational technologies than this, like railroads, like the steam engine, which quite literally turned human history on a dime. One might say the Industrial Revolution of the 1860s shaped up to be a much bigger net change from feudal-like conditions, let's say, to what we know today, Renaissance notwithstanding. And did that change the dynamics? No. The dynamics are still as they ever were. You get a hype cycle, that hype cycle implodes, and then you get the real adoption phase. And all the promise that Dylan is talking about is realized.
Vecchio.
Certainly I don't debate that. It's the valuations and the timing. Would I buy that narrative here now after everything we've seen? Not with your money.
Before we get to that, there's a bunch of earnings that did come out, and while some of them matter, some of them don't, I do think they're worth touching on. Snapchat, snaps out here, share prices, off 14.5% here after hours. Revenues were in line at 1.35 billion, but their adjusted EPS missed at negative 16 cents versus negative 15 cents expected.
No one cares about this company. Do you not agree?
No, I disagree completely, because this is the to quote you, the bullshitty social media company that Okay, so a few months ago, we shared a deck, I think that was sent over from Goldman Sachs or Morgan Stanley. I can't remember, but it was basically like if TikTok were to get kicked out of the US market, where would those users go? And they had these different funnels for the different features that TikTok has. And it's like, well, you could go to Instagram as like the next easily available substitute, or you could go to Threads or okay. At the bottom of every single category was Snapchat, right? So it's the one that
reinforced my point. I thought Snapchat was already a write-off.
Well, this is why it matters. When Snapchat, it's typically the first of the social media companies that see marketing funding get pulled. If companies are going to be pulling back any sort of spending and thinking about their budgets in a more austere kind of manner, they'll continue to pump the Facebook ads. They'll continue to pump the Google ads. They cut the Snapchat ones first because they have the lowest ROI and whatever of a user base compared to the other social media platforms. So it's canary in the coal mine. Frequently, it's been viewed as over the years, and maybe the guidance, which is right in line with the expectation, there was 1.48 billion. They're guiding at 1.48 billion. You know, they're not selling any dreams over here right now. They're not painting a brighter future than what the street expected.
But I'm just understanding your logic. You're saying the weakest of the sheep. If the weakest of the sheep is weak, therefore what?
If this was
if the first of the sheep that you fear might get slaughtered gets slaughtered, you start worrying about the other sheep.
But if there's one sheep that's to be slaughtered, is it not this sheep?
It feels like it is, and you know,
think that's fair.
There's a proper caveat here, which is feels like this happens every single quarter for Snapchat, where they just totally bomb out. The market, the market crawls back a little bit between earnings.
It exists to support that guy's lifestyle. I forget his name, that LA kid. I feel like this just exists to support that guy's like Instagram with private airplanes.
So Galaxy Digital is also out here. This is another miss. 8 cents EPS versus 10 cents expected. You know, not fantastic, but share price is off barely a little bit here after hours. SMCI is out as well, which under $50 a share after closing at 57.26. Sales miss 5.8 billion versus 5.9 billion expected. EPS miss 41 cents versus 44 expected. Their sales outlook miss 6.5 versus 6.6 billion. What about their EPS outlook for the Q1? Miss 0.46 versus 0.56. So SMCI down, not great. Galaxy off a little bit here. HIMS was yesterday, right? All right, Dylan.
Other than SMCI, I think it's very easy to take Dylan's perspective here and say these are not the names that are going to make or break the story.
I think SMCI is the most relevant of the list.
Yes, for sure. For what you're referencing,
for sure.
I would point out the broad picture here about earnings so far right now. This comes from FactSet. How have companies been treated by the market, depending upon if they're?
I think this is actually a huge point.
This is.
I was looking at this too.
Yeah. So if we think about how the market's been treating winners versus losers, winners are the 5-year average in the 2 days before, 2 days after a company beats on their earnings. It's a 1% gain. This year, it's about a 0.9% gain in for the second quarter earnings right now. If you're a company that has missed, however, missing has been problematic, and the stat just there it is. The 5-year average, again, 2 days before, 2 days after the earnings release, the 5-year average for a company that misses its earnings is minus 2.4% during that window. So far through Q2 2025, it's an average price decrease of minus 5.6%. So companies are being rewarded less than usual for beats, and they're being punished by twice the degree that they normally would be for misses, Dylan. And I think that just goes to like one of those hallmarks of, is this market overvalued? Is it oversaturated? Are we priced for perfection? Right? It's like,
I agree with that. I mean, I think that's self-evident. That basically.
Can I give an example though from like real life?
Sure.
Hopefully Dad's not listening. Where I went to college, you're only supposed to take 4 classes a semester. One semester I decided to take 5 because I was working out this whole thing where I'd have fewer classes by the end of senior year. I'd be living in my fraternity house. I don't need to do
It's
one.
gonna be a big fat party. I understand what you're thinking.
Right. Okay. So I take 5 classes that semester and I get 4 A's and 1 A minus, 397 GPA. And my
good.
dad said, yeah, I thought it was pretty good. And my dad said to me, that's it. And it was kind of like, okay, this is like the best you can do, pat on the head for 4 A's and an A minus. Right. And it was kind of like an FU. And that's kind of how the market's behaving right now. Like nothing is good enough. Right.
For the big man.
Yeah, nothing's good enough for the big man right now. And we're seeing the
If you
Nasdaq
take a look at the
5% right now.
The S&P, actually, it's a really interesting thing because this exact dynamic really starts with that happy days news that the EU and the US reached a tariff deal, which should be
Did we?
exuberantly good news. Well, yeah, apparently the EU agreed to eat a 15% tariff, at least for now.
Which I'm not happy about.
I mean, they're not happy. They're rightly not happy, but they do reach a point of some certainty between what is the number one and the number two most important consumer market in the known universe. And from a global growth perspective, this is incredibly positive. And the market goes, meh, and does nothing and fades it. And ever since then, the GDP number isn't good. The Fed is disappointing. Then the jobs data really spooks everybody. But this idea that the market is not responsive to good news, that it doesn't rally when the news is good. This is that thing that you see as the mirror image of the dynamic that Dylan, you're describing, which is the market is so happy with what is occurring that it just doesn't care. Bad news, whatever. We're starting to get through the looking glass, seemingly, and get the other side of that exact thing, which is the market stops caring about good news and starts saying, you know what, whatever, we're going lower. That's the hallmark of a market that is completely convinced in where it's going, whether up or down, when it decouples from news. And what we've seen in this version of the decoupling isn't that bad news isn't working and the market is rallying in its face. It's the opposite. Good news isn't working, and the money is coming out of the markets even when you'd think it shouldn't.
The dynamic in 2023, Dylan, when the Fed came out and they were like, "Oh yeah, like we're don't worry, we're not gonna hike rates again." You know, the market was. Yeah. Go ahead.
I believe I am 100% correct. I also believe Ilya is 100% correct. What I mean is the AI supernova is upon us.
I agree, actually.
The ability to value the AI supernova, impossible.
I agree with that too.
The present value of the current and future AI supernova, unknowable, impossible. Look at the Meta forecast.
Totally agree.
Idiotically wrong.
Totally agree.
Look at the missing of the boat at Apple. If I was to say to you, there's going to be an AI supernova, do you think Apple Computer will benefit? You'd be like, oh, hell yeah. They're going to be front and center. Okay, well, maybe not. Guess who's front and center? Microsoft. Left for dead decades ago. All of a sudden, they're the top of the heap.
Mm-hmm.
So I think that this really comes down to your opinion, Vecchio, as to who's right. The supernova, as advocated by your friend in Milan, or...
Go ahead, finish your framing.
The absurdity of the present value of the supernova, as advocated by your friend in Portola.
I mean, I think the only real difference in our perspective is sequencing and timing.
And present value. It's just what is the present?
That's it.
And I have no credible opinion of the present value, but for my belief of the idiocy and insanity of man, which I
And
believe.
for me, I completely see that. And clearly we've witnessed it time and time and time and time again. The history of financial bubbles tells us over and over again that things can inflate
Rational
more
versus
than
salted.
anybody ever expects, and that they'll snap at a weird time when nobody expects them to, and later than everybody expects them to. I mean, you don't have to go far. Go rewatch the Big Short and watch Christian Bale lovingly portray Michael Burry freaking
by
out.
nature, in their nature though, don't bubbles have to go beyond what would be rational? Because if they stopped, then
that's what would make them a bubble. Yes.
right.
Right. And so I think
And
in
that can only be determined
sense,
retrospectively.
right. And so in that sense, all you can do is
buy more.
trade the price action.
Is just get long and hang on, brother.
What would
Buy
Soros
yourself-
say, Ilya?
Time wise, yes.
When George Soros sees a bubble, what's the rational thing to do in his eyes?
Run it up as long as it'll run up.
Buy Meta.
Run it up as long as it'll run up. And in fairness,
Microsoft put spreads.
we've watched it, but you have to, I think, disassociate what you do as a bet on the long run transformation of this, which, by the way, I am in all of my non-tactical, non-45 day or 50 day DTE, not my active portfolio, I'm very long the stock market and will be probably for the next decade, 2, 3, whatever.
You know, Dylan, that old ESPN commercial? Yeah,
It's
you know
it's
that
a
ESPN
different
commercial?
time cycle.
With
But
John
as a
Clayton.
trader,
This is Ilya.
you have to look at this and say, this price action is telling you that we are becoming unresponsive to good news. We broke down from an uptrend last week. We retested it over the course of the past 48 hours, and the retest failed. That's what is on the chart currently. So you trade that from a trading perspective. Because the washout will not care that eventually the great and glorious AI future will indeed materialize. The washout on a trading basis will take your money all the same, as it did in 2009, as it did in 2000, as it did in the 80s, over and over and over and over and
When's
over
it going to
again.
do it, Ilya? When?
Nobody knows. That's why you have to trade the price action.
Nobody knows.
That's why you have to trade the price action. Exactly. And the price action says this could be the beginning or maybe not, which is why you have to trade it very carefully.
Becky, what are you doing?
What am I doing here? I'm leaning a little short.
Are you short the supernova? Are you nibbling on these sort of Russian expatriate turned eucalyptus sniffing Portola music listening man's?
So let's say in July I was doing something like a synthetic short calendar call spread. So if I'm long a calendar call spread, I'm long the longer dated option, short the call and the shorter dated option, right? But I was doing that basically the opposite. I was running up the NASDAQ calls and call spreads while holding on to these late August puts in ES. Not perfect. It kind of feels like that's, if I want to be bullish here, I'd want to have a long calendar call spread strategy. I'd rather be short the market in the short term. I'd rather be short the 24,000 call in NASDAQ that's expiring in, however long. In this case, we have the 23,200 here. But something like this, short the 17 days, long the 48. I'd rather be longer duration towards the end of the year than deal with whatever data digestion that we have to go through as the economy reorients itself around tariffs, which again, if you're to believe the PMI data, the non-farm payrolls data, the ADP data, everything that we've had into the stew, viability or not, directionally things are slowing beneath the surface. That's why we look at core GDP. and not just like the top line figures. We've gone from 2.9% to 1.9%, now to 1.2% in core GDP. So consumption and investment is slowing down over the past several quarters. And during that time frame, inflation has moved up from 2.4%, now back closer to 2.9. So higher inflation, lower growth as the economy is digesting the tariffs. Seems really textbook.
Mm-hmm.
So if we're going to go through this now, Dylan, where Congress is on the Epstein recess right now, the Fed doesn't have a meeting this month.
Great
That's what
way
they're
to call
calling
it,
it?
by the way.
That's what I'm calling it. They adjourned Congress early so that they wouldn't vote on the Epstein files. What else would we
That's what
call it? Yeah, I'm pretty sure my
sounds
congressman
like
might
you might
block
have
it.
a partisan bias as a Northeast liberal fellow. I guess would be a nice adjective to call you.
Call me a father of a young girl instead. That's my perspective on this. I digress. Congress is not in session right now. We have
There
the
you
Federal
go.
Reserve.
We
That's
appreciate
current.
that.
Federal Reserve is currently on its vacation. They have Jackson Hole later this month, but they're not going to be changing policy anytime soon. If there was a window with which the market could soften up for whatever reason, seasonals, this could be it. So if I think the calendar call perspective, I want it, Dylan, if I were really you and doing this in a responsible manner, and you and I
mean,
from
my
time
only
to time,
question for you is what part of the word supernova do you not understand? Something to reflect.
No, but you bring up a valid point, and this is the reason why I think that,
aware.
you know, in a K-shaped recovery world where AI is a layer on top of the economy that serves the financial and cultural elite, it need not worry itself with declining real income levels for lower and middle income consumers. And that is a horrific, scary proposition for how the economy and society could evolve. But it would mean that even if AI displaces people because it does produce this gigantic productivity boom, companies' earnings stay intact. They reduce their overhead for labor. Profits surge, margins explode, unemployment goes up. And in a world where unemployment's rising, what does that do for asset prices if the Federal Reserve has to keep rates low, or the federal government needs to do a UBI program or a public works
UBI,
program?
brother, UBI solves UBI is the hidden solution to all your problems.
So I just see long-term asset inflation because I don't see this country's political and financial elite doing the things that are necessary to get us on a sustainable course.
But do you think UBI is in the cards in the next 10 years?
In the next 10 years? No, but I would be surprised if it doesn't become a more prominent conversation as we look at unemployment rates for people, especially younger Americans, shoot up, especially for young men shoot up. Unemployment rates for men who are graduating.
Targeted gender.
No, I think you have to be worried about that because the preponderance of historical data shows that countries with high youth unemployment rates, particularly young men between the ages of 18 and 35, have higher incident rates of civil unrest. And I think that for keeping our society bound together,
maybe they should get a job.
I don't think that our society has properly catered to the changing dynamics that young workers, particularly young male workers, have faced in recent years. And it's not simply as getting a job, it's about the place in the world, what society has to offer us. I think the prevalence and the proliferation of gambling-like tendencies and influencers is all about getting rich quickly because the American dream has failed for so many people. There's no more ladder.
You're saying that the culture for young people, men and women, is a lottery culture rather than a work culture.
Well, because the upper crest of society has geared a tax system that shunts wealth from the lower middle class up to the upper class, particularly from younger workers to upper workers.
Advantage of the old.
Well, I'm paying a higher effective tax rate than people that are 65 right now in my local area.
The entire system is designed to benefit the 75-year-olds at your direct expense.
Because the system is designed for people to retire in their 60s and die in their late 60s and not live on until they're 85 or 90, which is wonderful.
Asset owners to exploit your willingness to pay a high tax rate and W-2 income to be treated like a punk while they live and play golf.
Yeah.
And carbon load the atmosphere such that you roast to death in the summer.
And I'm actually very optimistic about where this goes eventually, because I think that
because you're an asset owner.
No,
who lives in Silicon
yes.
Valley.
Yes, but I don't think where it's going is going to benefit me as an asset owner. I think it's going to benefit my children more so as the beneficiaries of what Dylan is describing. I think one of the things that the AI supernova does eventually is reorganize this in ways that we couldn't begin to fathom. The same way that railroads and telecoms reorganized their societies in ways that couldn't.
But the fundamental difference is that we have the transformation going right now, and we're building data centers, and we're not creating more jobs out of building those data centers by high degree, even though it's sucking up more electricity, even though it's sucking up
2 seconds into what this transformation is going to be.
I realize, but like the auto industry, you don't have diners without the automobile, right? You don't have auto repair shops without the automobile. We've now had
getting rid of the automobile.
No. But the point is that once the automobile jumps into existence, a whole other offshoot of industries have to pop up.
Of course.
What other industries have popped up that have provided jobs?
We won't know.
Universal basic income. There will be no jobs.
I don't think I'm signing up to that idea.
There's just going to be music in Portola and free money from the robots.
I mean, as fantastic as that would be, I think
sounds like a boring life.
What we're witnessing politically, socially, demographically, is the end of an era that started somewhere around the mid to late 70s going into the early 80s. That era had as its job the solving of an inflation issue. That solving of the inflation issue at the corporate level, at the government level, led to tax cuts and deregulation and the formulation of corporations as fundamentally shareholder oriented, which of course means reducing costs, increasing profits. All of that gave us globalization and other mechanisms by which costs could be reduced, because the problem that world faced was an inflationary one. And now we face a different issue. And the baby boomers are leaving the labor force, and they're giving up the reins of power, finally. And
are they?
Gen X is tiny, so they're not going to be replacing all these retiring baby boomers because there's just not enough of them.
It wouldn't be Gen X unless they're overlooked. So
just calm down about Gen X. Let's not be speaking about Gen X inappropriately.
Dylan, you are a unicorn among Gen Xers.
There's just not a lot. They're a small generation.
Well, I account for more than one. I'm a multi-person. I have a lot to offer.
We love that about you. Trust me.
And if only Euphoria sneakers were available in the US, we would wear it proudly.
Okay, let's not bring the sneakers into this. There's no one talking about sneakers here. I'm a barefoot. I don't even like to wear shoes, but that's a different issue.
Okay.
What we're witnessing across the entire landscape, politically, socially, demographically, is the handing off of one 50, 40-year order to the next. The ridiculousness, by the way, of the last election, where both sides come with equally old ideas and nobody likes it, and a third of the electorate doesn't show up because they can't be bothered to listen to the same thing from both sides that they've heard for 40 years, that they're all unhappy with collectively. It's a wonderful example of what's going on here. I think with AI, as with other examples of that kind of a technology, it will create more jobs than it destroys. It will solve more problems than it creates, but it will create issues as it does every time. And in 40, 50 years, we're going to have a massive issue, and we're going to have to uncoil that issue. And that issue will be the thing to resolve for that generation. But I actually agree with Dylan that this is a very optimistic moment for the world, because we are probably at one of these important inflection points in history, where the festering issues of the past 10, 15 years have finally come home to roost, and we're going to clear house, and everybody is so upset with everybody on every side that what's going to happen is we're just going to change the paradigm. And things that before were anathema are going to become how we solve things. And we're going to come up with new ideas. And
Meaning UBI.
Meaning all kinds of things. UBI is certainly, I think, on the table. I don't think that's where it's going to go ultimately. But to Chris's point, I think it's going to be very much a part of the conversation. It would be smart to deal with AI better than we dealt with globalization, where the majority of people benefited and a loud, ignored minority was, to the pain of everybody, left to hold the bag. Were we to just spend 30 cents of every extra globalization dollar to take care of those folks, maybe we wouldn't have this mess, but that's not how history works. So I'm very optimistic. I just think the valuations are off, and we need a cleaning of the house before that optimistic future comes.
Cleaning of the house. Hear the Soviet anthem playing in the background.
I would suggest that rather than a cleaning of the house, that there might be a tanning of the supernova. And
that seems like the most likely outcome here. Forget like the short-term path of the market in 5 years. Is the S&P 500 more likely to be at 3,000 or at 9,000?
Well, the frustrating thing, I think, for Ilya and I is we both completely agree with one another. And yet we completely disagree with one another.
So what's the trade for this week then, Dylan?
Buy Meta, buy Microsoft, buy Tesla, buy NVIDIA. Don't think about it. Don't overanalyze it. Don't talk to Ilya. Just calm down and sell some put spreads in the tickers I just gave you, and be happy when you have more money, and then just enjoy yourself and maybe have some steak.
I made some pretty good filet last night. Some of the names from the basket that we put together.
Not to talk to Ilya, because he'll make you doubt yourself.
Some of the names that we mentioned in January when we were looking at our phase 2 AI basket: Amazon, Meta, Google, Palantir, Snow, SPGI, FDS, IQV, UNH, and Axon. One of those is doing very poorly. UNH obviously has not fared well in recent months, but Axon, on the other hand, has been punching well above its weight.
UNH, I like your Luigi trade, which is either it's coming back up or it's going away. But anyway, you're saying something.
Well, if it's going away, it's worth more than the sum of its parts right now. Right? If you were to break it down by, think of it as a conglomerate.
Remember, the Luigi defense is that he had it coming. The defense is not that he didn't do it, it's that he deserved to be murdered. So the fact that the defense attorneys even think that that's a viable defense tells you how horrendous UNH actually is. Anyway, I digress.
No, it's remarkable.
Well, and the fact that there's people in the country that are like, oh yeah, that makes sense.
No, not just people in the country, the most elite defense attorneys in the world are like, okay, we cannot claim you didn't murder this man because you're on videotape murdering this man. So our only potential defense is to say that this man deserved to be murdered. And we believe that there's a credible case to say that.
I've been arguing with people about this in Reddit when I see people celebrating the murder of the Blackstone executive last week, Wesla Patner. Apparently she was attributed to having lived in my town. So this was like a whole thing up here. Oh my gosh, can we figure this out?
Cinnamon buns.
No, she had no family up here. So we don't know why the local news stations were interviewing people in town about her. Either way, though, like signs of this being some sort of class revolution. An innocent woman is shot because the guy went to the wrong office looking for the NFL for his CTE. Like, and we're celebrating this. Like, but isn't that a sign of the social decay that we're talking about, Dylan? Where like you have this K economy where there are things that are happening and the market's making money and society is moving on. And there's a whole bunch of other people who are just increasingly
It's the
getting left
pivot.
behind.
Yes. It's the sign of where the breaking point from the old order to the new one occurs. And you could be optimistic or pessimistic that it's going to go to something that you want to see or don't want to see. I'm optimistic that the US as a unique phenomenon in the world will reinvent itself in a positive way once again, as it has every other time that it's had one of these sort of inflection points, but they are always painful. I mean, one of them was a civil war, for heaven's sakes. And that's not what I think is coming. Let's just be clear.
Yeah, let's not. What kind of American are you, Ilya?
A very optimistic one. And a very patriotic one.
Eucalyptus sniffing one.
Yes, yeah, it all looks all right over here under the eucalyptus trees.
I was referencing Jesse Plemons' character in the movie Civil War, which is like a famous meme gag from that movie that came out a year or two ago. I digress. Top headlines of the day. Hey, he was excellent in Breaking Bad, and he's married to Kirsten Dunst, which is, I think, right? I don't know.
I have no idea. I have
Jesse
no idea.
Plemons. I don't know, but that's just why I don't know why that's in my head.
The young guy that with Breaking Bad guy, the redheaded guy, that good actor guy.
Yeah.
I like that guy.
Yeah. So, Dylan, to your point about this AI super cycle, OpenAI today, Supernova, it's releasing this lower cost model that's going to be hosted on AWS that should allow it to compete with Meta's Llama and DeepSeek's deep research models a little bit more effectively. There's obviously not a clear path from A to B here, but I find your relentless optimism somewhat endearing.
Thank you.
If only to say that I have never felt as bullish as you have.
About anything ever.
And I will say, given the tone and tenor of some of the comments that have come in over the course of today, and not just today, in recent days, people have been saying like, oh, Vecchio and Radigan are so arrogant, like this thing is about to come down. And it's interesting not being the person carrying the flag and listening to another bull disparage a bear like that.
Are you diminishing me in some sort of rhetorical, dismissive manner at this juncture?
No, it was like an outer body experience.
Okay. You're saying that this is the first time since we've been a trio that I have outbulled you as the bull.
I think so.
I think that's true. And
Probably,
I believe in the supernova, and I believe everybody should just calm down and buy your Meta and buy your Microsoft and buy your NVIDIA and just ignore Mr. Eucalyptus and enjoy yourself and be happy with your stake money. I think it's very simple.
And by the way, that is completely possible. And if I thought that it wasn't, I would be over indexed short, and I am not.
Because he's fearful of Mr. Stakes and Eucalyptus over here, and he knows
for the exact reasons we've been saying. Because this thing, for no reason discernible to anyone,
that's right,
can blow out bigger for who knows how long.
That's right.
Which is why, and then crash, which is why you also trade the price action. And the price action since the beginning of July has been maybe it's out of steam. And we'll see.
It could go on for years. This
or thing. Blow up tomorrow is my point.
But the odds of a blow up tomorrow are much low. The payoff, listen, I would love nothing more than to make the bear case. Obviously, nobody knows how valuable the supernova will be, how soon.
Of course.
So there was an analyst, this is Dylan, I want to like bring something to your attention about why this money has to keep going. This was sent over by, I saw this from Ben Badger, and he's a CEO and principal analyst at Creative Strat. Creative Strat is a market research firm. Okay. This comes from an executive at Schneider Electric, which apparently is a key player in data center buildouts. Quote, AI hardware is rewriting the data center energy equation. One rack of NVIDIA's Blackwell 2 now draws roughly 180 to 200 kilowatts, driving whole site demand from 300 megawatts to 1.2 to 1.5 gigawatts, a 4 to 5 times jump in a single architecture cycle. So these power spikes stress 30 to 50-year-old transformers and distribution assets that were never designed for such volatility, forcing these utilities and operators to rethink their reinforcement and on-site generation strategies. What this effectively means is that you are seeing a constant turnover here. There's a lot of other information within this about SMRs and hyperscaling, which I don't think is prudent to the conversation. But what they point out is that ultimately chip roadmaps and software volatility keep CapEx on the accelerator in the short term, with each GPU generation delivering higher density. Data centers require continuous electrical and mechanical retrofits. Hyperscalers are blending constant load on sites with burst capacity from tier 1 colos. That doesn't really mean anything to us, but this is like a Ouroboros. They build the data center, right? They're drawing on all this electricity. They now have supply available for consumers who are sucking up all the demand, and a new model's coming out. And so they need to add more energy and more GPUs to build the new model. And it's kind of like this flywheel right now where we're going and going and going. And so why wouldn't there be continuous demand for NVIDIA as inference grows and grows and grows and grows? It's a difficult pill for me to swallow to be structurally bearish on the AI space. That's not to say it's overcooked.
Right, but the reason to be structurally bearish, which I rationally fully agree with my friend in California, is only on valuation. Too much, too soon, too high, too many multiples, too much, too much, too much. And the only reason I disagree is because I don't think we're in a rational environment. I think a supernova suspends logic. I think the meta earnings are the greatest indication thereof. And I think you just need to calm down, stop thinking, stop analyzing, stop doing math, and enjoy yourself.
You know what, Ilya? I think that now that Dylan has brought us full circle to effectively quoting the President of the United States, relax, guy, I think we can leave it there. With that, overtime is out of time for this Tuesday, August 5th. We'll be back tomorrow, same time, same place, every Monday through Thursday, 4 p.m. Eastern, 3 Central, right after last call. So for Ilya Spivak in San Francisco, Dylan Radigan definitely in Milan, I've been Chris Vecchio for sure here in New York. Hopefully no more earthquakes. Please stop. We'll see you tomorrow. Quick break coming up next. More Ilya with Macro Money. See you there.
See you there, everybody.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
I literally spent like $2,000 to paint my car from red to black, and then like a year later, I didn't have the car anymore.
What's the most financially irresponsible thing you've ever done in your life?
Oh, yes. Okay. So when I was like 16 or 17, I was working at Jewel Osco. I was pushing carts. I was making like $7 an hour, $8 an hour. But for whatever reason, I decided my car had to be painted from red to black. So I worked for like 6 months. I literally spent like $2,000 to paint my car from red to black, and then like a year later, I didn't have the car anymore. So I worked for 6 months at Jewel pushing carts to paint my car for literally no reason. And that was the most irresponsible thing I've done. So don't let your kids do stupid shit like that.
What kind of car was it?
It was an Acura Integra.
Just buy a lot of near-term weekly options. If I had a $100,000 account, I was long like 20 grand's worth in the front month for sure. Don't do it, kids. Don't do that.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
You can get up to $4,000 when you open and fund a new account with tastytrade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new tastytrade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? tastytrade. Make your move.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to tastytrade. So spread the word and earn rewards. Terms and conditions apply.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
It feels good to get smart. Get even smarter with the ultimate how-to guide. Learn 31 different option strategies, covered calls, iron condors, jade lizards. Become a trading mastermind. Get the guide at tastylive.com/guide.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from tastytrade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. tastytrade. Download today.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
Diversify your portfolio with stocks, options, futures, crypto, and more. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. tastytrade. Download today. You can get up to $4,000 when you open and fund a new account with tastytrade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new tastytrade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? tastytrade. Make your move.
Calling all traders. Are you using Tasty Live mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, Tasty Live has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities, and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you would like the chance to share your trading journey and inspire others.
Hi, my name's Angeline Ong. I'm the newest member of the IGTV team. Well, I began my career at CNN Financial in London, covering everything from the financial markets to the European trading day. What I'm looking forward to working with IG is to be the best version of myself and to use all the skills that I have and help IG reach out to those clients out there who are, like me, looking to learn and are ambitious and willing to put themselves out there to learn more about a financial instrument they might not have ever used before. My philosophy is, if you're going to play, why don't you play big? Let's not settle. Let's try and learn more and become a real expert in the field that we are trading in. And that's what I hope to bring to IG in its strategy, in its content, and expand that across Asia, the US, and also Europe.
Stock markets fizzle after an attempted recovery at the start of the week from last week's bloodletting, and it happens against the backdrop of another troubling piece of U.S. economic data. So what is the U.S. economy actually doing, and how worried do the markets truly need to be? That's what we are going to tackle here on Macro Money. This is Ilya Spivak, head of Global Macro here at Tasty Live. Let's take a look at what we have on the menu in front of us then, and what the markets did today. We'll, as ever, begin with a look at the price action, see how we got there, and then try to figure out what comes next. This is the current, that is the September contract for S&P 500 futures. And we bring it up because the architecture of these moves today and over the course of the past several days really is eye-catching and seems to suggest that there could be something that's starting to happen here. So these tops right here, of course, established for us a range last week. This was the US and EU deal on trade. We get a gap over the weekend, and that gives us the top of where this range is, and we fizzle. The optimism doesn't last. The Fed right here, that's this third candle in this red sequence here. It's disappointing, but ultimately the price action doesn't find lasting follow through because we get into earnings, and of course then we get this massive gap and the new record high from the Meta and Microsoft earnings, which are explosively better than expected. But that too, the markets fade, and we end up finishing with a lower close than we did before on Fed Day. And then of course Friday last week, there's this explosive sell-off that finally cracks the architecture of this range. Now, that comes courtesy of the jobs report, which we'll take a look at once again in just a moment. But what's critical here is the price action itself. There is a very straightforward stair step up here that develops from these panic lows around Liberation Day tariff rollout in early April. Once the markets sort of digest what's going on and the White House seems to take a step back from the worst of what the markets are concerned about, you get this clean stair step up where former resistance becomes support on a retest. And so here's where you start to see the breakout. You set a higher high, you come back, retest these former levels as support, then set another higher high, retest these former levels as support, set another higher high, establish a range here around these former levels. Once they're taken out, again, former resistance becomes support, establish a higher high, and then here we break the sequence. If these are the previous highs, then we have failed on their retest and broken through. Moreover, when we start this week, the markets rally all the way back up to retest the breakout point for this range, and today we are rejected there. In other words, there is the early indication in the price action itself. Now, before we get to any indicators or news or whatever else, there is early indication here that the price action is beginning to roll over. In other words, that we have a sequence of higher highs and higher lows that has given way, and we are setting lower lows now. Now, it's, of course, very early yet, and we still have this very important level of support, which has been holding since early July at 62.41 or so. But the architecture of what the price action is doing here is very eye-catching, especially since the rollover starts not with a bevy of bad news, but with a bevy of good news that is faded. First, the EU-US deal. Next, those explosive tech earnings. Against this backdrop, today again, the outlook for Fed monetary policy pulls deeper into a dovish direction. We are now looking at 129 basis points in rate cuts between now and the end of next year. The markets are relatively anchored for this year at 50 or so basis points. We can see there's a little bit of fuzz around that. 52 basis points, that's basically a rounding error. And that's in line with what the Fed has been saying pretty much all year long. The real question is next year, and what the markets increasingly see as the likely disconnect from what the Fed is saying versus what they're going to have to do. The markets are now fully priced for 3 rate cuts next year, whereas the Fed has only forecasted 1. And today's data, the start of which is marked off the release by exactly the spot where stock markets start to sell off today, that reinforces this idea. And of course, we're talking about the ISM service sector report. It comes out disappointing, 50.1 on the service sector index. And perhaps the most critical bit here is that the biggest part of the U.S. economy is now at standstill. The service sector, of course, much larger in its contribution to the overall economy than is manufacturing. If manufacturing, roughly speaking, is about 20% of the economy, the service sector is closer to 70, 75, with the rest being ag. And so the service sector is really the key here. And of course, we've seen now a parallel deceleration in both services and manufacturing for quite some months. So it's not as if it is news, really, that the U.S. economy is slowing, at least on this measure. We've seen since the beginning of this year, that peak that you see on the manufacturing sector right there, that's January. And so this has been ongoing now for 7 months. The biggest point of contention here for markets is, first of all, this is much weaker than anticipated. The markets were looking for 51.5. They got 50. As ever, this is done in the logic of PMIs. So 50 is neutral, neither growth nor expansion, or neither growth nor contraction, I should say, in either of these measures. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. Last week, we got this disappointing bit on the manufacturing side where the pace of contraction accelerated, whereas it was expected to moderate. Now we have a similarly disappointing service sector reading, which was expected to accelerate for a second consecutive month in the growth direction. And instead, what we have is standstill, barely above 50 at all. And that, of course, taken together with an anemic and a contracting manufacturing sector, gives us an economy that has basically stopped growing on this set of indicators. And perhaps the internals here are the most striking and speak to what's going on with the Fed policy outlook and the market response thereto. The Fed, of course, has a dual mandate of price stability and maximum employment in that context. We learned from the manufacturing side that prices cooled, but nevertheless remain very elevated relative to where they've been and relative to where the post-COVID inflation shock is, which is, of course, here. In the case of services, the price structure actually continues to deteriorate in July, and we get to the fastest level of price growth since October 2022, which is, of course, right in the heart of the come down from the peaks of the COVID shock. Now, it gets worse. The employment side of things is in contraction mode, and we can see that across both services and manufacturing, not only are we below 50, that is to say employment in both sectors is shrinking, but it's shrinking at an accelerating speed. So we're getting deeper into contraction mode. And if we were to unpick the internals of this service sector report, there's really not a whole lot to like at all. Growth in new orders stalled, while the backlog of orders continued to shrink, meaning that new orders aren't coming in, whereas companies continue to work through the backlog, and there isn't anything by way of new demand to top that up. Supplier deliveries slowed. And both imports and exports of services flipped from expansion to contraction. Expansion in June, contraction in July. So all signs but the pricing structure seem to point towards slowing activity, which is how you land on near standstill here, whereas the pricing structure is pointing to aggressive inflation. And of course, this is precisely why the Fed has been leery of cutting rates. But from the market's perspective, these inflationary concerns are inherently temporary because the demand destruction from the tariffs that is fueling these concerns will ultimately overpower, and we will land on growth, cooling, and disinflation. And ostensibly, you might be seeing that already in the manufacturing side, where we've finally had a dip in inflation. And of course, the manufacturing sector is a little bit more cyclically sensitive. And so perhaps we're seeing the beginnings of that start to occur. But this is how you end up here, where the markets don't think the Fed is going to do any more than they've already projected, and they're anchoring around that. We can see there's something of a range that's developing here since the beginning of the year, with the bottom at around 50 basis points, in line with the Fed's thinking, and we've kind of oscillated between 25 and 50, one cut or two this year. And despite signs, deepening signs, as we can see here, of economic weakness, we're not really seeing us move out of this range, because the conflict between the direction of prices, higher, and the direction of employment, lower, is seen as keeping the Fed as likely to stick with what they've been saying and what they're comfortable with and no more. But the markets are increasingly seeing that this reticence is not going to last into next year, because the economic environment will be so dire that the Fed will have to stop sitting around and start stimulating in earnest, which is how the markets expect to get 3 cuts next year, while the Fed has only committed to 1 so far, and even that loosely. Now, we also saw the final revisions and the final outcomes on S&P Global's version of analog PMI data, and here the view is much more optimistic. We have a surge in the service sector that continues, and in fact takes us back to some of the heady levels that we saw in the second half of last year. That, of course, gives us a potent push on the composite index, because, of course, most of the economy is services. So if services is booming, then the overall economy follows. But a deeper slump in manufacturing, which has veered off in the opposite direction. So we're starting to look a bit like we did here at the midpoint of last year, which incidentally was when the markets, as we saw, had a similar sort of view, where here we can see that there was a steady view for 2026. The view for 2024 was similarly anchored, but then it was 1 year forward to look at 2025. And that's where the expansion in rate cut odds was really building, much as it is now building for 2026. Markets perceived a similar kind of a dynamic. And so what we end up with then is perhaps the market's looking at this and saying, well, maybe this is where we were at the beginning of July when the S&P survey was conducted. It was done earlier and was released earlier. The numbers we saw today were revisions. And maybe the ISM number or set of numbers is where this ultimately is going. And of course, that's the troubling part. And that's why the markets react to the ISM numbers today, much more so than they react to these S&P global ones. Now, even if we take this at face value and say, you know what, let's focus on the positive. Let's say this was the more accurate view, though the S&P global numbers are collected earlier than are the ISM numbers. We also got confirmation on those same numbers, final revisions across a number of other major economies. For Europe, we can see standstill, barely above 50, and indeed stuck there, stuck near that standstill as we've been basically all of last year and going into this year. In the case of China, the S&P Global and Caixin version of that data, again pointing to standstill. We have a slight pickup in services and a deterioration in manufacturing that sort of within the recent ranges gives us a net outcome that's a bit positive. And we'll take a look at what that composite landed on in just a moment. But it's not difficult to kind of put a midpoint through here and say, well, if this is pushing in this direction and this is pulling in that direction, then you probably end up somewhere just north of 50 for the composite. That matches the official numbers out of China. This is kind of their analog of what ISM is relative to at the S&P Global numbers in the US. So you get two PMI numbers, two different PMI numbers in the US. You also get two different ones out of China. You can see here the composite is basically hugging the 50 line. And that sort of reiterates what we've been seeing in China for now 9 consecutive quarters, which is a near total absence of demand. We can see here that going all the way back to where the initial reopening of the economy occurs, which is right about here, you get one good quarter into the end of 2022. And thereafter, things fizzle. In the solid line here is real GDP growth. In the dotted is nominal. Of course, nominal GDP includes inflation. Real GDP factors that inflation out. And when you look at the difference then where real GDP ends up above nominal, that means that to get from nominal to real, your inflation adjustment is negative. So nominal GDP minus a negative number is the only way you'd end up with a real GDP number that's higher. And that's, of course, exactly what we're seeing. The inflation coefficient on Chinese GDP has been negative, implied, for the economy as a whole for 9 consecutive quarters. And as you might expect, when growth is positive and money and demand are chasing a given bit of supply at any given moment in time, then prices rise. And that's indicative of demand outpacing supply. That's what growth is. This is the polar opposite of that, where clearly supply is outpacing demand, which is why prices are falling. Things are essentially on discount economy-wide in China. And that speaks to the near total absence of demand relative to the supply that's available. So where does this land us? Here, by the way, is that composite number for S&P Global. For China, it's 50.8, so just about here, right in the middle of these things, as we've been saying. And even if you take the optimistic view then and say, this is the real deal for the U.S. economy, it's growing at a level that is analog to the very heady growth we saw in the second half of last year, we can see that Europe and China are basically stuck near neutral. Both are certainly growing, but the pace of that expansion is anchored at only a hair above no growth at all. And we've been anchored here for the better part of last year as well as this year. And this really is why the markets seem to be so concerned. Because if this is the lay of the land, then the one economy that cannot fail of the top 3 that drive global growth is the US economy, because there's no real meaningful support coming from the other 2. As we've pointed out frequently here, 58% of global GDP is just these 3 economies. And of the remaining 42%, most are vendors to these 3 that depend on these 3 to have demand. So the influence of these 3 is actually in excess of their size in the relative GDP pie. And so in this, the most optimistic version of the story, you have a single point of failure on global growth. And then what this suggests, and why these ISM numbers were so disappointing and so eye-catching for markets, is this later conducted survey suggests that maybe that thing you can't afford to have happen, the failing of this runaway engine and its potential to correct back down to where these are, that's maybe starting to happen. And that goes to the jobs report that we've just seen. Of course, very disappointing at 73K, but even more so disappointing in the prior month's revisions. We can see here the cumulative 2-month revision here. If you squint, you can see it's all the way down to 258,000 jobs that were in the earlier estimates that were phased out. And you can see when those kinds of revisions of this kind of magnitude occur: COVID recession, global financial crisis, the recessions of the 1980s. And of course, the GDP report, which for the second quarter gives us a bunch more noise around what's going on with imports. They surge, then they fall off, and inventories, they surge, they then fall off. But it's the contribution from consumption that's the most important, because that's 68% of GDP. And these numbers are so small that between the first and second quarter this year, we get the weakest 6 months of consumption since the first 6 months of 2020, the COVID recession. And so this is perhaps why this is what we're looking at. Because the markets are starting to conclude, looking at the preponderance of data that is played out here over the course of this turn, that the U.S. economy, the one engine of global demand you couldn't afford to fail in this environment, is starting to decelerate in a worrying kind of way. And if you look at the way that that's happening, the Fed is not going to come to the rescue until the pain is far more acute, which means the economy has all kinds of room to weaken before there is action from policymakers to push us in the opposite direction. And against that backdrop, positive geopolitics, positive earnings are being ignored. And what appeared to be a breakout last week now appears to be reinforced after the bounce at the start of this week hits a wall. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. Likewise, on with Chris Mondays and Fridays for Futures Power Hour, on with Chris and Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com, and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Good luck trading.
You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new Tasty Trade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? Tasty Trade. Make your move.
We're going to go to New Orleans. I got to be in New Orleans. What's up?
Y'all three guys, just the whole organization is just phenomenal, and it's changed my life. And I wish more people would just sit back and listen to y'all and take it seriously, because it will change your life if you enjoy trading. I don't know if I could ever repay any of y'all for this free advice and free teaching y'all do. Is just remarkable. Tom, I got your hat on, and ever since I got it on, I've been blowing the market up, so make sure you don't give one to Tony or Scott, because I don't want them to benefit from us.
That's okay. Good job out of you.
Got trader's block? We've got the cure. Get data-driven trade ideas with Cherry Picks, our weekly newsletter that gives you insights into the market. Sign up at tastylive.com/newsletters.
Your crypto needs a wallet, and crypto is better when it's tasty. You can now do more with your digital currencies with the Tasty Crypto app. We're proud to offer a self-custody wallet for Bitcoin, Ethereum, and Polygon. Transfer your digital tokens directly in-app and access thousands of tokens available only on-chain. Your wallet is your key to decentralized finance. Download the Tasty Crypto app and get started today.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
If you've ever been curious about where to start with crypto, join me, Ryan Grace, for the Tasty Crypto Show. Alongside co-hosts and industry guests, we'll break down what's going on in the market and show you how to take advantage of crypto. No hype, no shills, just crypto know-how. Watch us live, join the chat, and fill your bag each week on the Tasty Crypto Show.
Forbes called us best online for options trading. With stockbrokers.com, we're #1 for options and futures trading. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
If you've ever been curious about where to start with crypto, join me, Ryan Grace, for the Tasty Crypto Show. Alongside co-hosts and industry guests, we'll break down what's going on in the market and show you how to take advantage of crypto. No hype, no shills, just crypto know-how. Watch us live, join the chat, and fill your bag each week on the Tasty Crypto Show. Your crypto needs a wallet. And crypto is better when it's tasty. You can now do more with your digital currencies with the Tasty Crypto app. We're proud to offer a self-custody wallet for Bitcoin, Ethereum, and Polygon. Transfer your digital tokens directly in-app and access thousands of tokens available only on-chain. Your wallet is your key to decentralized finance. Download the Tasty Crypto app and get started today.
Forbes called us best online for options trading. With stockbrokers.com, we're #1 for options and futures trading. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
What is going on, everybody, and welcome back to Risk and Reward with Ian Gus. Gus, we got another PLTR of the week. We'll be getting into a little bit of that, hash out some of the details, but it's been a pretty volatile week. How are we doing today?
Yeah, doing good. We were just discussing our favorite Soulja Boy songs before we started the stream. Everybody, let us know your favorite Soulja Boy song in the chat if you have one.
678-999-8212. I think.
That is what it is. Yeah, we were having a little acapella session to give the full backstory on. But Catan, sorry to hear about your boat being attacked by the orcas. I guess I don't know if this is fake news or not.
I heard they're vicious sometimes.
Orcas,
petty.
well, they are. I have a whole thesis about orcas controlling the stock market.
Let's hear it.
I've never told you the orca thesis?
No.
I think I have.
You should have started with that.
Yeah, man, orcas. Okay, I've definitely done this on this show before, I think. But Orcas, there's the Orca salmon hat thing. You're telling me I haven't told you about this?
Orca salmon hat. I'm not catching on.
Man, yeah. Orcas, they exhibit this strange behavior where they'll put dead salmon on the top of their heads and swim with their heads slightly above the water. And scientists don't know why they do it at all. They think it might be some kind of social thing. But it's only been documented 3 times in history, and it coincides with the 3 most recent massive market crashes. There was one in '87, there was one in '08, and then also '70s oil crisis and all that. There was one in the early '70s as well. So if the orcas start wearing salmon hats, the market's going to crash. That's my theory. So I don't know how Catan being attacked by an orca exactly plays into this thesis.
Only
but
time will tell.
The orcas are getting active is the point.
No, orcas are getting active. I hear orcas can be pretty vicious. I mean, as we get into it, the markets have been pretty vicious. It's been volatile. Last week, at the end of the week, we had a pretty big sell-off. Over the weekend, we gapped up, rallied a little bit, and then we kept on rallying today, and then we sold off again. I'm curious to see if we're going to continue to rally, but a lot of fluctuations into a lot of these positions. Anything else standing out for you?
Yeah, I mean, when Meta and Microsoft had those insane earnings beats last week, and then that still wasn't enough to, keep the market propped up the following day, I kind of thought maybe we were, starting to see the end of this rise and taper off, and maybe we would enter a much-needed 1-month breathing period a little bit.
You would think.
But that does not seem to be the case. It seems like we've turned right back to pushing to higher highs. Earnings season has been kind to a lot of people. I mean, not so kind to others, such as the nature of earnings season. But yeah, it's an interesting one. We got some earnings trades to discuss here as we dive in.
Yeah, we'll go ahead and jump into it. We can start pulling up some of these slides. We do have a risk of the week, another PLTR on a meteoric rise.
There we go. That was good.
Meteoric rise.
You really sounded that one out. Yes, risk of the week, and then we're also going to talk Palantir. Great earnings call. I think this company is freaking fugazi, but we're going to get into it. So let's dive straight over. So first of all, kick us off with your risk of the week.
All right, guys, we got a new risk of the week. I think last time I did SPY, I still have that position on. I sold an added money call spread. The move that we got at the end of last week helped me out so far. We'll see if we get bought back up. That was last week. This week, I'm feeling RKT. I know RKT's been going around a little bit. It's a cheaper underlying. They're up 40% year to date. That could be a good thing or a bad thing. It's like if an underlying is moving 50%, within 6 months, that can either mean something really good or really bad. So they've been in headlines so far. Rally's been driven by a lot of bullish sentiment. I mean, some major acquisitions like Mr. Cooper and Redfin, super high short interest, maybe because of how much we've been rallying lately. I mean, last time we learned super high short interest, I mean, people like to jump on those. It reminds me of the GameStop saga. But I know we had last earnings for RKT, we beat earnings, we had higher EPS. The stock still faded. I mean, with cheaper underlyings, I mean, it's really difficult, like fundamentally speaking, for them to prop their stock up and sustain it at those levels. So I'm curious to see how they'll do. Not that we care too much about the fundamentals, but then we have some of the analysts, current price trading at about $18 for potential more upside, but I'm going to be getting short on RKT. So instead of joining the momentum and joining the herd this time, I'm going to look to buy a put. Debated on selling the call, but I think we're going to go with buying the put just in case we get a drop and we can see an expansion in volatility. So that's what we're going with this week, guys.
Yeah, I like this one. I think trying to short these meme stocks as they come back down is a wise strategy. It can be a tough one to time.
Meme stock.
If you're willing to hold through the pain a little bit. No, that was Open Door, and that thing is a freaking meme stock. As is this. I don't know. They got good commercials.
Nah.
That Rocket Money app looks lit. Yeah, you seen that thing? They advertise like crazy. It cancels your
you want to know what's so
subscriptions.
funny? The first brand deal that I've ever gotten was 4 or 5 years ago. It was a company called Truebill, right? Truebill does exactly what Rocket Money does. A year or two later, Rocket Money bought Truebill. So technically, Rocket Money is Truebill. And Truebill...
Technically, you're sponsored by Rocket Money.
No, this was... No. But it is funny how things panned out because I ended up downloading Rocket Money later on because I was curious about it. Come to find out, they're the ones that actually purchased Truebill. So looks like they might take it to higher heights. But when I heard Rocket Money, I was like, that sounds familiar, but there's no way this is... I think I have Rocket Money on my phone right now. And I think I'm paying for it. I think I have a subscription to Rocket Money. But anyways, we're going to go with Rocket Money.
You better cancel that thing if you want this to come back down.
It's actually pretty cheap. You know what's cool about Rocket Money? If this is the same...
Bro's going to endorse the company. He's going to say, I'm short Rocket, and then just give a glowing endorsement.
So I do have it downloaded, but it needs to be re-downloaded from the iCloud.
Sure, where it does like the auto.
Yeah, and then you get to choose what's kind of... This is not at all, but you gotta choose what you want to pay monthly for it, which was a very different model than I was used to seeing any company incorporate. So I wasn't choosing Rocket Money because I've seen it before, but when we keep talking about it, I'm like, yo, I have used this application before. So it's been moving off of a lot of momentum, a lot of speculation. But we're going to be getting short right now, so
yeah, love shorting the memes. It's such a great thing to do. You know that these companies must return to their fundamentals sometime. Yes, you will be validated, especially if you're willing to hold through a little bit of pain. It works. I don't know if I've told this story on air before, but when GameStop, the OG original GameStop saga, I wanted to short it on the way back down, and I did it, and it got too painful, and I cut my losses, and like the next day it came crashing back down. I would have been up so big. I lost like $900 very valuable dollars my freshman year of college. So yeah, I'm with it. Short these memes, baby.
Yeah, no, I mean, I feel that completely. I mean, when you see like your net worth fluctuating like that, like me in college too, bro, that was me. It's like a $200, $300, $400, $500 loss. It was like, all right, where do I?
Yeah. I guess I'm having ramen again for dinner. Yeah, exactly.
No, but that's going to be my risk of the week. We'll see how Rocket Money pans out. We'll see how. All right, we'll see if we can sustain some volatility.
For sure. Let's jump over. My risk of the week is DoorDash. I believe I put this on as risk of the week a few months ago, and I got long. And I still really am a buyer of DoorDash in the long term. However, based on their recent price action, I just think that this thing is really overinflated right now. I mean, a killer trade after their Q1 earnings report. It took a dip down into the 170s. I took a spread. I needed 170, and it has just ripped since then. I actually wish it was a naked call. I was just telling you that the other day. But it's up 50% this year. It's up 35% just since the start of May, which is about when I entered that position. Fortunate for me. The run-up is justified. They've made smart acquisitions. They bought 7 Rooms and Deliveroo, which were the two largest UK food delivery services. They also operate in Australia and a few other places. And I really like those acquisitions. I think it bodes well for global expansion. And I'm really playing more into what I think the market is going to do rather than what I actually think DoorDash is going to report. I don't have any opinion on whether I think DoorDash is going to meet, exceed, fall below expectations. But the last earnings call was very bullish. They beat EPS by a lot. Revenue came in on target, and they announced that they had spent over $5 billion on these 2 big acquisitions, all cash, no recurring payments or anything like that. And the stock slid 12% on that news. That was why I entered the original position, was because I was like, wait, this is bullish news to me. I don't understand why the stock is sliding. And since the market has priced in my sentiment on that one. But now we're at this incredibly overextended price point, in my opinion. It closed at about $255 today. Analyst price targets hang at $212 to $240 right now, and I don't put a lot of stock in that, but I think that is a good reflection of the broader sentiment that I can't even find one analyst saying, oh, this thing's going to go to $350. And these recent acquisitions are going to hurt their short-term margins, and I think the market is going to overreact to that. Yeah. I think that is something that should totally be expected and be priced in, but DoorDash is going to come out and say, oh, we just spent all this cash, so we're coming in a little bit tighter on capital than we thought we would this quarter, and that people might overreact to that. I think, like I said, I buy into the long-term thesis of DoorDash. I think that this company is only going to grow. I'm an avid user of DoorDash myself, but just in the micro here, and this is incredibly binary. My contract expires Friday. I want to isolate this binary event and do nothing else. I'm define risk. I bought a put spread, and yeah, I think it's overextended at the upside. I think it needs to breathe. I think the market really wants to push this thing down, and I think they would have to blow every expectation so far out of the water for this to take any sizable move up. So feeling pretty good about my position there. I need it below 250 is my critical number.
Yeah. So no, I like it. I'm always curious to see how the company acquiring the company, how they pan out, like in terms of the response from the underlying stock, and then also the company being acquired. The reaction from their stock.
I always think it's interesting, and especially when and this was a rare time with those buyouts where I just wholly disagreed with the market action. Usually I can find the validation, but not only do I think that they're strong acquisitions that will make them a lot of money in the future, but also they had $5 billion in cash laying around. Is that not a sign that the company is doing pretty well? I mean,
or healthy in the time being at least. I mean, I know one thing. So what's funny is, I know with a lot of small caps, I used to really love watching the mergers, the acquisitions, things like that. Something I noticed was a lot of the times the company buying the company takes a little bit of like a temporary hit, because I mean, they just forked out a ton of cash. So they take a temporary hit for a potential investment on their money. So I really like to see kind of how the company being acquired, if they get any type of short-term momentum.
And I think the acquisitions thing is so interesting, because when Amazon says we're making a multi-billion-dollar expansion we're going to spend billions of dollars to build distribution centers in the UK, everyone's like, awesome, and Amazon goes through the roof. But then DoorDash says, oh, we're going to spend billions of dollars to buy our 2 biggest competitors in the UK, and for some reason it tanks 12%. It's strange.
That's valid. I guess I could kind of see Amazon and DoorDash low-key on a different playing level too. I kind of see Amazon more of like a they're so unfair. I see Amazon as like literally every industry now. So I see Amazon even, I wouldn't be surprised if Amazon has their own DoorDash system in the future.
They do groceries now with Whole Foods.
Okay,
Yeah.
so I guess there we go. It's like a direct competitor there. But yeah, very interesting. We'll see how that kind of pans out. But I do like Dash. What is that trading at right now?
Yeah, we will see. Yeah, I think it closed just over 255 today.
Okay. Up there.
Yeah, so it's on a tear, and I think the tear will continue. I'm looking to get back long into this after this, especially if my trade is correct and a good buying spot presents itself. But I just don't see any way they can make higher highs.
Yeah.
That leaves
us up on the small cap. Small caps. Those are pretty poor fundamental companies, no doubt. I think it's stocks under $10 is technically considered a penny stock, and I think 90% of penny stocks end up filing for bankruptcy and getting delisted off of the NASDAQ. So
let me tell you about a little company called Aerotine International.
I didn't even mean to. So that's funny. We can go ahead and jump to the
only thing you're going to regret, Aero, is that you didn't buy more. All right, let's dive over. That leads us straight into our primary segment for the day.
Awesome.
We've lost slides here. My apologies. We'll hop back over. Leads us into our primary segment for the day, which is Palantir. Palantir, on an absolute tear. Everybody, if you're a trader, you know the name Palantir by this point. 340% gains last year, up over 100% this year already. This thing just keeps going. They just had a very profitable earnings call today. Yes, today. And they moved up another 8%. And so I just wanted to take a second to talk about Palantir, who they are, what they do, and if this move could possibly be justified. So, a few quick numbers here. They're absurd numbers. Palantir is trading at 295 times their forward price to equity, and they're trading at 661 times their trailing price to equity. This is insane. That makes it the most overvalued large cap stock in the United States by the definition of overvalued. There is nobody that is trading at a higher forward PE ratio than Palantir. They went up 340% in 2024. They went up 130% in 2025, but they somehow have done all of this and increased their earnings and their margins with no matching increase in employee headcount. Now, on one hand, that shows scalability for sure. It shows that you're able to do more than everybody else with less than everybody else. But the contrarian point to that is that this company, their market cap is so ridiculously much higher than anything they could feasibly do anytime soon. It is absurd, and it's trading purely on hype, is what it is. And anytime you see something trading in the triple digits of their forward PE, fundamentals have gone out the window, and we are talking pure hype. So it's just this really interesting situation to me, because logically you would say, oh, well, eventually this hype is going to die, and they're going to have to be evaluated by their fundamentals, at least to some degree. But we've been doing this for years now, and it just keeps happening. So I don't know. I don't know. What are your thoughts?
I like PLTR. I think the momentum is going to continue. I think outside of the fundamentals, I think PLTR, the train isn't done. And with the fundamentals, PLTR was one of those that have been around for a while. I think PLTR was the first or second underlying that I think I ever placed an options position on. So in terms of the fundamentals, I'm excited for it. But I'm more so hoping that the momentum continues to the upside.
Yeah. So let's talk today. You can take us away.
Cool. Now we got a strong Q2 earnings for Palantir, raised profit forecast. We had that on Tuesday, Tuesday. Estimates are looking good. Revenues are looking good. The stock reaction, boom to the upside. We gapped up and ran a little bit more to the upside. That's showing investor confidence, in my opinion. Not only are we getting a pretty big gap up to the highs, but we're still continuing to run to the upside. And then we closed green on the day. So it doesn't seem like the sentiment has shifted at all here. If anything, it seems like it's only continued, but now it's kind of harder to get involved because now we're trading at these extreme levels to the upside. But they did have a solid Q2 earnings beat. And PLTR, it doesn't seem like they're slowing down anytime soon.
Yeah, it really doesn't. And in a vacuum, a considerable beat on a percentage basis on your EPS, exceeding revenue. I don't think that in a vacuum, I don't think that these numbers are unjustified for an 8% move. I think that is sensible. I'm not upset about it, but it's just, we continue to trade just so far ahead. And I don't know, it's like, with the way that we're treating this thing, we're acting like they're going to put the first man on Mars or something. Maybe they are.
With how discreet they are, sometimes they might be.
It's true.
That's what I'm saying. Some of their filings, it was a little vague, especially 2, 3, 4 years ago.
I ain't giving my money to the mystery man. Are you kidding me?
If stock go up, we going up.
I mean, if stock go up, but I mean, stock go up on
absolutely.
It's just it's so far
100%.
from justified.
100%.
It's so far from justified.
Right. How would you consider it? Just position sizing? How do you get involved in this?
I don't.
Right.
I don't. I feel that is the safest call for me. Is I don't, because if I got involved with this thing, if I were to get involved with this thing, I mean, 20 times over the last 2 years, I would have said, today's the day. Yeah. This thing is overvalued. Yeah. It has to come back down. I would just be shorting the hell out of this thing, getting my lunch handed to me day after day.
It's real though.
Yeah. So I keep my hands off, but it's just so interesting because I think that a Amazon, I think that a Tesla, these companies, and I really mean Tesla by proxy of SpaceX or whatever. When you buy Tesla, you're buying Elon. That's something we've established on this channel before, but. I think an Amazon has much more propensity to like take over the entire world in the way that we're acting like Palantir is going to. And the reality is that they only made $1 billion last quarter.
I agree. I mean, they do not have even close to the facilities as Amazon does, and not actual facilities. But we'll go ahead and jump to the next slide here.
Yeah, let's hop over.
Some strategic initiatives. Is it me?
Yeah.
We got a lot of.
Go ahead.
We got some strategic initiatives. We got a lot of AI. AI still seems like it's the buzzword, but at this point, it's not even just a buzzword. It seems like AI is something that these companies are taking very seriously, especially with something like PLTR. So we have here their goals to deploy AIP to about 85% of its existing clients by Q4 of 2025. That's a pretty big push, right? They got a lot of goals for the end of this year, which is. We're already into the 8th month. We got 4 more months.
And it doesn't matter if they meet these goals. They're just going to keep going higher either way. Yeah.
Apparently. The plan includes launching industry-specific AI agents and cutting deployment time in half. So, I mean, efficiency. I know the best way to get efficient at anything is systems. And then a system will allow you to be able to scale whatever you need it to. So I know they're consolidating a lot of their files, a lot of their data. I know that's one of the last bullet points there. Didn't mean to pull from the last one. But they're looking to scale. Whenever I see them getting systems down, cutting here, it sounds like they're making room to scale for what they didn't have room for already. So analysts expect the platform expansion into a new enterprise in 2025, potentially lifting guidance. So if they get those guidances lifted, or lifting those guidance, we could see more positive outlook from PLTR, especially headed into the new year.
Yeah,
they're not even going to care about if these goals are met by the end of the year if this sentiment, because the market is moving off of vibes sometimes. It's feeling
especially with this stock. I mean, this is the most vibe-driven stock in the market right now. I mean, by the numbers, that's the case. Yeah, and I agree. I mean, I think they absolutely do have the scalability. They're doing great with their AI integration, and they are trying to integrate AI into spaces where I think it makes a lot of sense that I don't know why other people aren't focusing on, like we talked about with Surf Air, and the whole reason people are amped up about Surf Air is because the AI that Palantir is developing for them could potentially be applied to all air travel and air traffic control, and that would be this huge earth-shattering thing. But yeah, it's just, I don't know. It's really hard for me to buy into a company that is trading on vibes this much. It's interesting, but yes, legit.
What do you got to say about the SPY? QQQ? Sometimes I feel like SPY and the indexes are trading off of vibes. Sometimes
I think that's true, but I don't know. I mean, that's at least an aggregation. Nobody, I mean, there are people that obviously, I mean, I do it, buy and sell SPY and QQQ, but that is. SPY and QQQ largely serve as a reflection of what is happening across the entire market. And any individual.
Are you saying our economy is moving on vibes? I don't know if you know Kyla Scanlon, not a little plug, but she's great work, fundamental economist kind of person, and she has a lot of great content out. And she made a piece one time talking about how the economy is moving on vibes. And from then, it stuck with me. I was like, we've been using the word sentiment. That's the old word, but the young generation word is vibes.
Well, yeah,
like we have been moving
we talk about the market moving on vibes all the time, and I mean, the whole economy kind of has been moving on vibes ever since our deficit entered the trillions, and we just continue to function somehow. Nothing is real, but yeah, it's an interesting one. But the military contracts are legit, and let me be very clear: I don't think Palantir is a bad company. I don't think this is a company that can't be successful or can't grow. The share price pisses me off. The market cap pisses me off. All right, commercial partnership and diversification. I just alluded to the Surf Air partnership that we've talked about previously. Also partnering with, is it Sauer, S-A-U-R? I don't know, Sauer Group. Deploying AI for complex management using their Foundry. Their Foundry is a big deal. If you try to research Palantir, you will see the word Foundry 100,000 times, and then eventually you have to cave and Google what is Palantir Foundry.
Wait, what word again?
Foundry. Oh. That's what they call their systems, their
which one?
AI. What?
What is it called?
Foundry?
Oh yeah, just say it one more time. Foundry. Just drill that in.
Yeah, yeah. No, I'll forget. Anyway, Fedragoni, that's recent, as of June this quarter, integrating AI tools to revamp their manufacturing and supply chain operations. TWG Global, embedding AI into financial and insurance workflows. And again, I understand that if you are buying Palantir, you are buying AI to an extent, much the same way as NVIDIA was for a long time, and still is to a degree. And they are providing all of these solutions to people. I think that all of this is very promising stuff, and I think that AI solutions and workflows are definitely going to be the future of business. So I think that there's a very, very strong market for this, and I can see the bullish case. I just can't buy into it.
100%. Clearly, as we know, Gus is definitely not getting long PLTR for the rest of the week.
I am this close to going on a Bill Ackman Herbalife situation with Palantir.
Bill Ackman Herbalife situation.
But I'm not gonna.
Starts going in on PLTR. PLTR is scared of Gus. Don't put out any hit pieces against us. No, anything else to add before we hop on out of here today?
Yeah, no, I got nothing else.
Cool. Well, we got Rocket Money, we got DoorDash. We'll see how that pans out the rest of the week.
We're short both, right?
I am short. Yeah. Got some more short delta on into the portfolio. We will be back here live 4:30 o'clock Central Time. Love you. Appreciate you guys hanging out with us. Be sure to stay tuned for more segments coming on next. We'll catch you guys next time. Peace.